As well, we have Adrian Movat of JP Morgan who joins in. Adrian, it's looking quite tough for the Indian markets, especially when you compare it to the likes of China. What's happening and are you worried?
Well, we have seen general market weakness, including H shares, so Hong Kong shares from their April high. So generally, sort of EM's off about 6%, and India is sort of marginally underperforming that correction from recent highs. So I wouldn't treat this as too India specific. I do, though, get a feedback from clients that they don't see near-term drivers for the market, and they were disappointed in the RBI credit policy with just a 25 basis point move and a suggestion that the RBI is on hold for the foreseeable future. We do worry that central banks are setting policy in the headlights of the Fed rather than for local conditions. And with, Indian economic numbers relatively subdued and inflation modest, I think the economy could have done with a more aggressive move by the central bank.
Hi, Adrian. Good afternoon. The last time we spoke to you, you said that, even what we're seeing in India is perhaps just a routine correction, that 15-20% corrections in emerging markets is not something that would worry you. But now that we've, slipped below that 8,000 mark, technically it could open up a lot more downside. Would that worry you?
Yeah, so, 8,000 it's a nice round number, but, we would agree when we look at the technicals, India looks pretty weak, as do many markets at this point. So, again, India's not on its own. So I'm looking at a market that's down about 10%. 10 to 11% from the March highs. Again, as you are highlighting, this is something that happens in emerging markets. There might be further downside, but when you start to look out and think about what's going to be happening in India as you move into 2016, you've got still the fastest growing economy that's a major economy. You're likely to get more traction in terms of fiscal spending. We've been looking at the heavy and medium commercial vehicle sales in India, which sequentially are looking pretty good, as are passenger vehicles. Anecdotally, we're hearing pickups in transaction volumes in the property sector. And I think these IP numbers have been quite weak in India because of imports of steel, which has suppressed domestic steel production. And maybe the IP numbers are giving an overly bearish story on the economy. So I would, if we get further weakness, I'm a buyer of this market.
Okay. Adrian, what is your sense in terms of how spooked the Indian markets or maybe FII reallocation could be taking place on account of what's taking place globally, and in reference to maybe the German bonds possibly hardening to 1%, the US Treasury is also hardening? Does that have any sort of correlation to the FII outflows that we've been seeing recently for the Indian markets?
Yeah, so what I've been looking at there is to see whether we're getting a spike in volatility in emerging market bonds. And there's a very modest increase in volatility, nothing like what you're seeing in the German bond yields. And I always think the best idea when you see these rapid moves is to look at it on a longer time period. And if we look at US Treasuries, we're back to where we were in October last year. And a sort of similar story with German bonds. So we got to this technical position a few months ago where the ECB is buying German bonds. There's a very, very large demand for regulatory capital in Europe. And obviously, if you're holding regulatory capital, your preference is to hold the highest rated paper, such as German paper. And I think that's how we ended up with these abnormally low yields in a very illiquid market.
Adrian,
we're now seeing a correction in the other direction. But it doesn't seem to be based upon high flows, nor does it seem to be based upon extreme bullish positioning, which is what you would have seen in bond markets in 2013. So very long answer to I don't think this is an issue for Indian equities or emerging markets.
Okay, about 2 months ago, you had cut your overweight position in India, I think in favor of in favor of Korea and Taiwan. So if the call now is to buy the dip, where would you like to begin nibbling?
What I'm interested in is, particularly after the correction we've seen, is trucks manufacturers. I'm interested in building materials. And we've seen some reasonable corrections in the banks as well. So, it's really these medium-term themes that you're looking to buy in when confidence is low and people are struggling to see what the near-term drivers are.
Okay. Adrian, what if we have a below-average monsoon? What if that does come through and, it's at 88% of the long-period average? Do you think that the markets would correct further only based on that? And would you get worried, or how are you tracking the monsoon, particularly from an Indian market perspective?
Yes, so certainly. I think investors are already quite anxious about rural demand, and they are concerned that with the late arrival of the monsoon, that there might be more pressure on food prices, and that would come in two levels. One is that the government would be more actively supporting the rural area and perhaps increasing minimum support prices. You might see some weakness in some of the PSU banks if there is policies that are encouraging more lending into rural areas. So there's definitely a lot of discussions with investors about the impact I'm still going to call it the late monsoon, because I always think these percentages are a little bit dangerous to deal with. We were looking for, typically it would be around the 10th of June that you would be expecting the monsoon, crossing through Maharashtra, and then 15th of June getting into places like Gujarat. And as we're currently sitting, it's particularly late in arriving onto the eastern coast of India. Let's see how it looks in a week's time. If the monsoon just arrives late, I think that's okay. If it turns out to be one of, poor distribution, then, that is a negative. We can't get away from it. It will mean inflation's a bit higher. It will mean rural demand is a bit weaker. Although we need to put that in context of what's already been reasonably lackluster rural demand, right?
Okay. Adrian, leave us with some thoughts, because I think you've been investing in the Indian market since 1994, and correct me if I'm wrong there, but you've seen a lot of ups and downs for the Indian markets. How worried or spooked would you be by this correction, and what are the targets that you're working with maybe on a year-end basis for the Nifty or the Sensex?
Yes, well, August 93, but we're still very bullish on emerging markets as an asset class. We're beginning to see, a convincing trend that the earnings growth in EM is now exceeding developed markets, which is something we haven't seen since 2010. The discount of emerging markets to developed is at quite an extreme level. Positioning is very bearish in emerging markets. And what we think is going to happen is, markets aren't going to make much progress ahead of the September meeting of the Fed. The last time the Fed normalized rates in 2004, it was a major risk-on event. And emerging market equities start doing very well. I've been asked for the last 2-3 years what's going to happen to EM when the Fed raises rates. There is a completely wrong conventional wisdom that when the U.S. starts to move policy rates from extremely accommodative to more normal levels, that money flows back to the United States. That's not what happens. Risk appetite builds, and it tends to be very good for emerging markets. So I think you're going to get high returns out of EM equities going into the year end, and I think India will be a big part of that story.
All right, Adrian, thanks very much for joining in. At least some bit of soothing of nerves, I guess, one can take away from your interview. Thanks very much at the moment.